Well, it was sheer bloodbath today on D Street with the Nifty plunging below that crucial support level of 7,000. We're now at levels both on the Nifty as well as the Sensex way back. As compared to May 2014, we're at those low levels right now. Pick up any stock, it's even senseless talking about individual stocks considering any and every sector was really nosediving today. And the carnage today, Nikunj, and that was the peculiar fact, right? That it was almost a synchronized sell-off across the globe. We were not alone in the pain. Had China been open, perhaps they also would have nosedived just the way we did. So did Europe, so did all other emerging markets, and even Dow futures, which are indicating a gap down start. And one, just looks puzzled at the trading screen and wonders what went wrong today.
Well, Asha, it was a horrible, pathetic, poor and a day of excruciating pain. Frankly, it started because of what has happened to crude prices in last 2 days. The communication from US Fed last night was nothing short of confusing. And then you had local issues. What will happen to STT? Will long-term tax come back? So there is a lot of confusion and chaos about the policy environment. Technically, we are in a weak spot. The sentiment is not with us. Liquidity is moving away, and earnings support is missing. So it's a perfect storm right now, where we are getting twisted from all these sides.
Oh yes, indeed. We collapsed below the 7,000 mark for the first time since May 2014. The carnage spared no one, with the Sensex as well nosediving over 800 points. Leading the fall today were real estate and metal companies. Having said that, banks were equally battered and bruised. All sectoral indices were pressing the red signal. You saw brisk selling as risk aversion globally seems to have now increased. And like I said, European equities as well tanked with the wave of selling coming in. Banks and mining stocks have taken the plunge over there. To put this entire chaos into perspective, we've got the biggest market voices joining in the next half an hour to try and analyze and dissect what went wrong today. Prashant Jain from HDFC, Bharat Iyer, Saurabh Mukherjee, as well as Bala joining us. And of course, we've got an entire research entourage as well to try and dissect what went wrong in trade today and what is the buzz now on D Street. We have with us Ajay Sharma, Mubina, Yatin, as well as Vivek waiting by to tell us exactly what happened. But Ajay, I'm going to come to you first. The cut was extremely brutal. What is it that you're gathering from the institutional desk? Is this it, or is there more to come in the next few days?
Oh yes, that's correct. It was a brutal cut. In fact, the situation on several institutional desks was very grim. We spoke to several dealers who service both the HNI as well as the institutional community. Most of the institutional guys were reporting sell flows from their clients. In fact, they go on to say that the orders are still not exhausted and are cautioning against stocks which have still very high degree of FII holding. In fact, some of the desks also spoke how desks in clients in Asia and Singapore, the FII clients were actively also considering shorting positions and already creating some shorting position. There is also some unconfirmed rumors and buzz about possible long-term capital gains that was making the local crowd very nervous. I'm talking about the local HNI traders and traders here based out of the trading desks. Apart from that, earnings are not really coming through. In fact, some of the PSU banks had very bad earnings. That also dented sentiment on the street and gave reason for bears to come out and actively start shorting the market. Big HNIs, we understand, some of them at least at some desks are also getting margin calls with this kind of a massive capitulation. So that is likely to continue with some amount of pressure coming days. So net, the situation not looking great as far as the action on institutional desk is concerned.
Well, you look at the price action, well, it may not look like 2008, but it is certainly smelling like 2008. And Mubina, days like this, they get the fear of God back in you.
Oh yes, absolutely. The fourth consecutive day of carnage for the benchmark indices, during which the Nifty alone has seen a loss of more than 500 points to tank 6.8% just from Monday. If you'll just look at how we have fared intraday, today alone, we have wiped off around 3% in intraday trade, the biggest intraday loss since 24th of August of last year. But the markets have, if reports suggest, they have wiped off a whopping 3 lakh crore rupees because of this fall. And just last year, we saw the Nifty touching that 9,100 all-time high. We have come off 23% since then, just in this 1 year. So that in itself figures the kind of volatility we are seeing in the markets. 13 out of the 50 Nifty stocks are trading at their 52-week lows. Quarter of the mid-cap stocks as well are touching their 52-week lows. Now, one would think that, quality names would be left out of this carnage, but this time around, they too were not spared. So we had the likes of Monsanto, Thermax, all of these stocks as well were touching their 52-week lows. So like Aisha is mentioning, you're really not alone, and there are all these stocks, being left out and are currently at their yearly bottoms.
Oh yeah, indeed. In fact, on that note, I'm going to bring on our first expert on board with us. Bala joins in all the way from London. Jai, hi, good evening. Thanks for taking the time out and speaking with us. And when one thinks about the trading session today, one's got goosebumps. What went wrong with the world today?
Aisha, no pressure, See, the problem is the what is missing for the markets between December and January was the spike in volatility and the capitulation phase. That has actually started in the market. And now we saw in the India VIX in particular rise 20% today. That is a classic washout low we are looking for. That's the final stages of a collapse that you normally see. And the fact that markets have went down so sharply is actually positive in a counterintuitive way. But you got to be a bit more patient at this point of time. Let the market settle down. Once it settles down, we can start deploying cash. Sitting on cash at this point makes a lot of sense. Or you can deploy something like 10% to 15% of your portfolio, not beyond that. You got to be patient at this point of time. Patience is the key at this point.
Bala, for those who are practitioners of patient and long-term investing, they are suffering right now because Nifty has now gone back to the so-called pre-Modi era. Gold prices are sitting at a fresh record high and Nifty is sitting at a fresh record low. So all those who thought that India is a great long-term story, they have become doubters now and they are the sufferers.
Yeah, that's true. See, from a long-term perspective, I'll try to get not too technical. The market's decline from 9119 hasn't been on a start of a new trend type of a thing. It's probably, if you look at it from a long term, it's given up just 50% of the gains that's it gained from post-Modi, appointment as a head of BJP. It went from 5119 to 9119. It's given up 2,000 points, or slightly more about. So it's almost like a 50% retracement we call in the Fibonacci retracement. So from a medium to long term perspective, the move from 9119 is still looking corrective on a longer term, but you've got to be patient, and we want to see a big reversal come through, which I think is going to happen. How do we distinguish between a bearish setup and a bullish setup? When the reversal comes through, the market itself will show its characteristics. We'll see gaps, big up days, and the pullbacks will be shallow. There are many factors to look into it. The most important point we got to there are a couple of tabs that you need to keep. One is crude, another one is the Japanese yen. Crude needs to bottom, without which the market is not going to bottom. We've seen a lot of people come and say, last year when crude dropped from 120 to 40, they said it's going to kick in a lot of positives, and nothing has happened. In fact, crude has gone even lower. The market has gone even lower. This is a classic deflationary scenario. We want that particular asset class to stabilize. Once that happens, it's another indication the market is bottoming, and from a long-term perspective.
Jawala is making some interesting points, which is that volatility has really gone up. For the longest time, we've had a world where volatility was not high. Everyone was able to predict the next Fed action. Everybody was comfortable with what central bankers were doing. Volatility has come back, and you don't know what's going to come next. Historically, if I look at the 2008 crash or the 2000 TMT crash, first the event happened and then markets reacted to the event. Right now, markets are preempting a bad news. Something will blow up somewhere, an oil-producing nation will go belly up, there would be default in the junk bond market. So it's very interesting that we have a market which has reacted well in advance in anticipation of an event. Since you don't know the event, that is causing volatility, which is injecting nervousness.
Yeah, but the comparison with 2008 comes in time and again. In fact, now as the Nifty is at its lowest level since 13th May in 2014, it's imperative to find out what are the correlations and what are the differences between now and then when we were at the similar 7,000 mark. Yatin joins in to put those stats into perspective. Yatin?
Well, it's a very interesting data point as to how the asset classes were performing in May 2014 when the index level was at 7,000 and today we are at 7,000 Nifty, and how are the asset classes. So let me take you to the stocks first because that is the most important data point. So if you look at Vedanta, Kane India, Hindalco, all of these stocks are down 50% from that level. So, at 7,000 in 2014, we have Hindalco and all these metal stocks lower by 50% when the index is now again at 7,000. Similar is the case with BHEL, Tata Motors, which are down 30% from those May 2014 highs. And if you look at L&T, ICICI Bank, SBI, all of these stocks are down anywhere between 25% to 15%. Of course, talking about other asset classes also to make the comparison more interesting, we have the MSCI Emerging Market Index, which was close to 1,022 in May 2014, and today it's corrected by nearly 30%, now close to levels of close to 730 points. Crude, that is one interesting commodity because of which we have seen some serious selling in emerging markets and global equities. Crude was at $112 a barrel in May 2014 and today it's at $27 a barrel. We are better off, but as an asset class, crude has done disastrous. Also, if you look at gold, it is almost at the same level, almost $1,300 to an ounce versus $1,220 right now. Rupee, that is one currency which has taken a beating. May 2014, rupee was at 59 to a dollar. Today it's at 68 to a dollar. Almost a 20% kind of appreciation is what we saw in the dollar versus the rupee. So rupee clearly has seen a big weakness. Nikkei almost at the same level. If you look at European markets, everything has corrected 15 to 20%. So despite all those index levels and the typical psychology, we have seen significant amount of price erosion in most of the asset classes and emerging market indices.
Well, one can safely say, Yatin, that 2014 was a reactive market and this is a preemptive market.
You look at the sentiment of, if pendulum of investor sentiment, it was hope. There was hype in 2014 after the change in administration. Everyone thought that a new age, a new era had dawned on us. But then economic reality is haunting us. Economic recovery is not there. Both locally and globally, the realization has kicked in that central bankers cannot print their way to prosperity. Printing money is not helping the cause. And central banks are indicating to financial markets, they are there for you, they're standing for you. They will print more money. And yet markets not reacting. So if you actually bought equities in 2014, you've made money, you've not made money. You've not made money in crude, you've not made money in gold, and cash has been the best outperforming asset class in the last 1.5 years.
Yeah, it has, and I'm afraid it would continue to be so at least for the next few months. We're going to take a very quick break on that note. When we come back, continue our discussion with Jay Bala and get you lots more other market perspective from Prashant Jain, Bharat Iyer, as well as Sridhar Sivaram. The bloodbath in the Lal Street continues with the Nifty and Sensex plunging to lowest levels since May 2014 and the Nifty tanking below the 7,000 crucial level. The carnage clearly spared no one. But it's wrong to compare the current market downtrend with the crash in 2008, says HDFC AMC's Prashant Jain. Speaking exclusively with us, he says the corrections led by global factors have always been great buying opportunities.
I think I always believed that equities are, this is the precise nature of equities, that everyone tries to forecast the markets over 3 months and 1 year. But I don't think equities are amenable to short-term forecasts. So I think with hindsight, one can always explain this is what happened, that is what happened. But I think the simple nature is that equities over short to medium periods are very hard to forecast. And however, I think what is surprising is that the outlook for the Indian economy, to my mind, is steadily improving. And we are trying to revive the capital expenditure cycle, and that takes a bit of time.
What should an investor do in this kind of an environment? You know, we're getting queries, we're getting emails. Is this a repeat of 2008? Why should they not panic? Gold has started moving up again. Why should they, you know, go back to equities?
No, I think, I'm sure, the number of people who are calling you today is much less than what they were 5 years back, because steadily people have realized that equities offer a great opportunity in India. And I would look upon every correction as an opportunity to buy. In 2013, were people not worried? In 2008, were people not worried? So whenever there is some challenge outside India, we have seen markets fall. Foreigners sell because there are some challenges outside India, so their investors are redeeming. But as long as the local economy is not challenged, if the local economy is doing well and markets are simply falling because foreigners are selling because of problems outside India, it is quite commonsensical that that's a great time to be buying.
Bala, let's come in on this comparison of gold versus equities. Gold is at a fresh record high. Equities are at a fresh record low. So do you think we can take the movement in gold a telltale sign of what is coming next?
See, you can't. See, markets have correlations, and the correlation wax and wane. There's never, a direct correlation all the time. So it's always sensible to, not treat asset classes in a correlated fashion. You have to take the individual assets and on its own merit, and then you should project what you're going to do a year forward or something longer. But as I said, at one point there was a one-to-one inverse correlation between dollar index and the IT index. Now it doesn't happen. That's what I mean by saying correlation wax and wane. You have to treat each asset class on its own merit. So while gold is picking up, it doesn't mean that it's going to be negative for equities. So you got to be very focused about each asset classes. And I'm sure gold is going to rally much higher, but in a certain very short term, even equities will rally together. They could say, okay, it's inflationary, every asset class will go up. No, be focused, don't use correlation. That's a very important lesson the market has taught us during this environment of QE environment. You don't treat markets in a correlated fashion. You treat each asset class on its own merit.
Yeah, indeed, one can't help and draw comparisons with the last dreaded historic move in the market that was in 2008. But I'm going to just bring on board our entire research team back. And Vivek, I want to come to you and highlight the kind of damage and capitulation, if I may use that word, that we saw in the broader markets today.
Well, it has been quite merciless even on the mid-cap and the small-cap stocks as well. Mid-cap, Nifty mid-cap is actually trading at its lowest level since October 2014, and the small-cap again is at the lowest level since May 2014. Now, if you look at only today's session, almost 1/4 of the Nifty 100 mid-cap stocks hit their 52-week, fresh 52-week lows. And talking about the Nifty small-cap, it was even worse. It was almost 34 out of the 100 Nifty small-cap stocks that hit their 52-week lows in today's trading session itself. Now, talking about some of the names that have lost almost over 70% from their lifetime highs. Some of these smaller names like JP Associates, JSPL, even banking counters like Bank of India, Canara Bank, DCB Bank, these two are down almost over 50%. Now, looking at some of the slightly larger names, well-tracked companies, we have Just Dial that is trading well below its listing price itself. We also have Jindal Steel, Wokhard, Arcom all trading below 40%. Now, talking about the small cap, small cap index is down almost 27% from its lifetime highs. And looking at some of the biggest autos, these are some of the well-known names. The Amtech Auto is there. We have a Kaveri Seeds there. We also have an Eros, and finally we have a banking auto like OBC as well.
Vivek, thanks really for highlighting the mid-cap carnage that was playing out there, and some of the fancy names have just begun correcting, so who knows how much more pain and slide there is in the next few days lined up. But Ajay, Yatin as well as Mubina, thank all of you to really highlight what transpired in trade today. And Bala, thanks so much for taking the time out and really putting this chaos today into perspective for us. We'll wind it down then on this edition of the big sell-off. Just hope that tomorrow is not quite a repeat of what we saw today. It's a goodbye from Nikunj and me as well. We'll catch you tomorrow morning with all the market action. As we wind down the show, hear it out from Saurabh Mukherjee as well as Bharat Iyer as well as to what they make of the market mayhem right now.
If I look at the global situation, my reckoning is there's more pain to come. I think last I looked at MSCI EM was roughly down, I think 37-38%. In most of the historic sell-offs, MSCI EM has comfortably fallen 50%. So there's very little reason to believe that somehow emerging markets have bottomed out. And if you look at the sell-off in global banks, now leave EM aside, just look at the share prices of European banks and Japanese banks. Those bank share prices are now beginning to factor in deflation in the rich world countries. If we do get into a deflationary scenario, i.e. prices actually start falling.
If no one is in a desperate need to participate right now, one is better off being on the sidelines because this market will give you better entry points. What is your view?
I guess what he says makes sense. I mean, the market may not give you a meaningful entry point in terms of downside, but you want to see a bottom put in place. You don't want to catch a falling knife. So yeah, I mean, I would agree with that.
So what is that point at which you would say the margin of safety now lies with a long-term investor? It is now time to participate.
I guess one has to wait for central bank action from the developed economies, Nikunj. I think because in an environment like this, it's typically central bank action from the developed economies which typically helps put a bottom in place. Otherwise, investor sentiment can be very, very fickle and you don't know where it ends up. So once you see that action and once you see markets stabilize, particularly the Chinese currency and the dollar, I guess then, that will be the first indication that one can start buying.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.